Hey, party people, welcome to this week's Money News in Human Words, where I'm going to be diving deep into what's going on in markets and the world. This week, the first piece I wanted to cover was around some changes to investor behavior in the current market environment. Now, this came out as a result of, it was in the AFR. They did a bunch of research on investor behavior and what's changed in the current market environment. What they found was that 29% of investors have reduced the amount that they're putting into investments. 41% of people are reducing their investing to cover the higher cost of living and household bills. 32% of investors looking to build emergency savings, and 29% are waiting to jump in when markets rebound. Now, my take on all this, the first point there, that 29% of investors reducing the amount going into investments, it's a really bad move in the current market environment. This is now the time to invest more when the share market is down, not less. You want to be picking up investments at discounted prices. Good companies that were good investments 6 months ago or 9 months ago are still good companies today, and will be good companies in the future, better performing investments as well. I get though that the point on the rising cost of living, obviously everyone's facing that. We see it at the supermarket, at the petrol prices, so it is understandable. But the thing that you should be looking to do as much as you possibly can when it comes to your investing is to look ahead and factor in some of these potential changes, particularly the rising interest rates, and being prepared for that, so it doesn't need to throw a serious spanner into your investing plan. The comment on or the data on 32% of investors looking to build up an emergency savings. This is a reminder for me of the importance of having a good emergency fund in place at all times, because one of the things that I saw a lot during COVID, when the COVID pandemic kicked off, that a lot of people ended up feeling more exposed than they really wanted to be. Like job security was an issue, and a lot of people were scrambling, and then they had to rush and build up their savings, which again, the markets were down, so there's missing an opportunity to invest. Your emergency fund shouldn't be about what's going on with markets. It shouldn't be based on what's happening in markets today. Instead, it should be based on what's the right amount for you, factoring in all of the different elements of what's going on with your money. So building your emergency fund when markets are down means that you are missing out on that opportunity to invest more when good investments are discounted. But when you have the right amount of money in your emergency fund all of the time or from the start, it means that when things like this happen, which we know are going to happen over time, then you can be aggressive when people are being fearful, and you end up benefiting as a result. And to the last data point on the fact that 29% of people are waiting to jump in when markets rebound, it's a really scary exercise because you're trying to time the market. We don't know when the bottom of the market is going to be and when the ideal time to invest is. And my experience with this is, even when people have a solid strategy, they're scared to pull the trigger when the markets are down. If you're trying to do this all on your own, it's much more likely that you're going to miss out on a lot of the upside because people are still talking about that uncertainty as markets recover. Not even the professionals can pick the bottom. So I don't think you or I can do that either. And I think it's important to recognize that. It means that you're going to end up getting better results, because all of the while, if you're sitting on the sidelines, your money is just not working for you, not generating you any income or any returns as well. So definitely some shifts that are happening, but a few lessons there and things to look out for to make sure that you get the best results when you invest. Another interesting piece I was looking at last week is around the fact that buying a property is cheaper than renting in now 518 suburbs around the country. Basically, in these suburbs, the cost of the repayments on the average house is less than the average price of rent. In some cases, by as much as $1,000 a month or $927 a month. Even though we're seeing massive rises in interest rates over the last 5 or 6 months. Now, I suppose the devil is in the detail with this. And if you look deeper into the data, not all states and not all areas are impacted the same way. Particularly Queensland, Western Australia and the Northern Territory, they have the highest percentage of suburbs that are favouring buyers over renters. But in New South Wales, Victoria, and the ACT, they've got very few suburbs where it's cheaper to buy than rent. So yeah, in New South Wales, where it's the most common, I suppose only 6% of New South Wales suburbs are cheaper to buy a property than rent, 4.4% in Victoria, 1.4% in the ACT. So what we're seeing at the moment is that a fall in house prices is improving one aspect of affordability, which is the upfront, how much you need to get into the property market. And so as property prices fall, it means that your savings can be a bigger chunk of that property to deposit, but the servicing of debt is still a challenge. And what we're seeing, particularly as interest rates rise, it means that people's borrowing capacity is reducing. So looked at some CoreLogic data here who found that in order for first home buyers to service a mortgage on a median house price in Australia, which is $791,000, they would need an annual income of 132,000, just over 132,000. For a unit with the average value is 604,000, they would need an average income of $100,000, which compares to the average income in Australia, which is about $92,000 at the moment, according to ABS data. So it means that you need to have an above average income in order to service, but that's not all of the picture, because serviceability is declining. So the 6 recent rate rises have slashed the maximum amount a family earning $150,000 can borrow by $195,000. So that means that a family can borrow $195,000 less at the moment. For an individual, it's $146,000. And every time the RBA increase interest rates, it means that the amount that you can borrow reduces and reduces over time. Now, the current market conditions do create an opportunity, but you need to understand that there's a lot of different ways to build wealth and a lot of different ways to be right when it comes to property. So I think the important thing through all of this data is that you want to be smart with how you plan now, even if you're not taking action right now, so that you can get the best results for you. Looking globally now, and one of the things that was in the news last week was Liz Truss resigning as the UK Prime Minister. She'd been bounced essentially after just 44 days in office off the back of a horrific budget that sent markets into a spin. I talked about this when it came out, and where they were talking about doing these massive tax cuts to get the economy back into shape. But all of these cuts were unfunded at a time when the economy was already in trouble and the government budget was already into trouble. Markets went into a spin, bond market, their central bank had to step in, and all of the support for her basically evaporated. Now, this all came down to economic management. So I feel like it's over there, at least, there'll be some likely significant changes with whoever comes in. They're talking about Bojo coming back to the job, which would be pretty entertaining to watch. But this will all be decided pretty quickly by the end of the month. I think that there will be an impact to markets for sure, but there's an opportunity there for global investments if they can get it right. And once again, there's a good time to travel to the UK while the UK pound is in the bath. Perhaps, hopefully, the Australian government is watching on with their budget coming down, knowing that they need to be doing something and delivering something that is going to work, or they could be facing similar sort of pressure. Closer to home now, talking about the unemployment and jobs data in Australia. Last week, a bunch of jobs data came in, which was weaker than expected, but it was showing that there's actually more jobs out there that people are looking to hire for than there are people looking for jobs. The unemployment rate held steady in this data at 3.5%, but only 800 new jobs were created, which was falling short of the 25,000 new jobs that they predicted. In New South Wales, the number of people that were looking for work edged down to 148,000, which we recently saw. The recent data showed that there's 150,000 jobs that are available out there heading into the month. So we're seeing this weird situation where unemployment is super low, but there's still more people that are looking to hire people than there are people looking for work. That, in one way, is a good thing for the economy, in that We know with a really low unemployment rate that people are all in jobs, the people that want jobs can get jobs, and that does good things for company profitability and economic progress moving forward. But on the flip side, not these companies not being able to hire, and the gap between jobs and people looking for jobs is a bit of an issue. So this jobs data, I think, is one of the key areas to watch moving forward. Again, on the Australian side, one thing that I was looking at last week, which I was really sad to see in the news, was Labor talking about potentially capping super balances at $5 million. Now, they've come out saying that they open the door to having this $5 million limit on the amount that can go into super. And they've said, which is obviously very true, that super is there for retirement, and you don't need to have more than $5 million in your super fund to live a comfortable retirement. Obviously very true. I think there's no arguing with that. But from my side, I think the big problem with this and what they're talking about is the fact that they're mucking around with super again, and people already don't have confidence in the superannuation system. I talk to a lot of people, and where it's clear that superannuation is the best thing from a tax perspective for them to do, but there's just a deep distrust that's out there. And it's no wonder when every time the government comes up with a budget deficit, or they want to try to shore up their bottom line, they go trying to make changes to super to free up a bunch of cash. Now, there's 11,000 Australians that have more than $5 million in super, and they talked about that changing these rules could potentially save like $1.5 billion or something like that over time. But again, like, there's just this deep distrust of the super, and the fact that the government keeps moving the goalposts. So hopefully this one gets shut down quickly. And look, my last piece of this week, and I suppose it's in line with what I was just talking about with the potential changes to super rules. Tomorrow night, budget coming out, Aussie budget coming out this week, with Dr. Chalmers to deliver his first federal budget. There's been a lot of talk about the state of the government's revenue and loss, that essentially their budget deficit or surplus position, and we've been in deficit for a while. But at the moment, the low Aussie dollar, record low unemployment, strong commodity revenues, and good company profits means that budget's actually in surplus, and the gap is being closed faster than expected. Now, the Labor government are talking about making some structural changes to the never-ending borrowing and ongoing deficits, which is something that should be addressed. But they're talking up some of the challenges that we're currently facing, in my view, to justify the pain that is coming. They're sort of blaming what's going on in the world at the moment, and this inflation rate, and the potential challenges that sit around that. But the fact is that a lot of the spending is really things that were in place and have been in place for some time, the biggest of which being the massive National Disability Insurance Scheme, NDIS blowout, which is currently costing taxpayers $29 billion. That's looking to increase to $60 billion by 2030 and $50 billion in just a couple of years, with a lot of experts saying that the number could actually go much higher than that. Now, these sorts of things, the NDIS has been in place for a while, and there's strong social argument around these things, but blaming the inflation and the current situation for the fact that they need to, repeal tax cuts or put whatever measures in place to shore up their bottom line, to me, it just doesn't add up. Now, I suppose time will tell, and I'll be keenly watching along tomorrow night, and we'll put out an update on that once we get all of the data and details. But potentially some changes coming. There's talk of stage 3 tax cuts, mucking around with super, pursuing wealthy individuals and corporates. So pretty exciting night for money nerds out there when the federal budget gets dropped. But stay tuned on that one, and I will give you guys an update once we get the detail. Guys, that's it from me for this week. I will catch